Coming up today, stocks have their best day of 2025 on the back of good headlines. Ahead of NVDA's AI conference, consumer sentiment falls to a 29-month low. Is gold going to $4,000 an ounce? Is a market crash still coming? Or did we just see the bottom in stocks for 2025? You're going to love this one, guys. Let's go. And welcome back to Click Capital, everybody. On this bullish breadth of a day, something we've been looking for a while now, the S&P 500 just had its first 2% green day so far this year. It's actually the best day since the election last year. And so what we're going to take a look at in this video is, did the market just put in a bottom? I'm going to show you a bunch of interesting data and charts from across the market, and I'll let you decide by the end of this video what you think. We just had over 1.3 trillion added back onto the market today with some big moves and growth names out there, along with other prevailing themes in the market. I'll show you later on in the charts. And this comes just after the market had given back over 5 trillion just in the previous 16 trading sessions alone, and what has been a very fast and sharp pullback. And so we're getting a bit of a bearish to bullish pattern on the charts here today. My market risk on off indicator flicking back to green on the charts here, whilst the sector trends showing a bunch of green up the front, with the defensives continue to be a little bit soft. They kind of gave us the early tell this week, along with a bit of an early tell going into this sell-off. They perked up a bit early. Also got my S&P 500 oscillator almost creeping out of the oversold territory as well. So pretty good technical signs here today, especially in the Magnificent 7, up almost 3% today, looking pretty good here in the MAGS ETF. A lot of volume pushing up into the close there. And this is on the back of a number of positive headlines today. We had Senate Minority Leader Chuck Schumer said he'd support the Republican spending bill, helping the government avoid a shutdown, and also think the lack of new tariff headlines. Plus, we actually got a little bit of talk of a potential progression towards a trade deal between Canada's new Prime Minister and the US admin. I'll show you what he said in a minute. But all that in addition to some end of week rebalancing going into the end of the quarter over the next 2 weeks, I think got the market feeling a bit good here on Friday, even though we still finished the week lower. But stick around, because later on in this video, I'll show you a little known unique indicator I've never talked about before, which can quite often predict market bottoms, for which I just got a signal for today. And this is something you can look for in your life as well. So hang around for that. I'm sure you'll find it interesting. And if you're new here, welcome. My name is Jared. I've been trading and investing for 20 plus years. I previously worked for an investment bank, and now I trade for myself in addition to making these videos every day after market close. So if you haven't already, smash that subscribe button, and these videos will show up in your feed every day. And if you watch these videos every day, I promise you will understand what's happening in markets, learn something new, and ultimately make better financial decisions for yourself and your family. And to all my loyal daily viewers out there, some who have been with me right from the start, I want to express my gratitude to you guys for tuning in every day, hitting that like button, and sharing your comments. I truly do appreciate you guys, as you've helped to make this channel, Click Capital, one of the fastest growing financial channels out there. So thanks very much for that, and let's dive right in. Like I said, we just had the best day this year, the best day since the election, the first 2% day, at a pivotal time when the market was really on edge coming into today. As I said yesterday, things were pretty much as bad as they can get, looking at a bunch of readings. And even though the consumer sentiment survey came in weak today, which I'll show you in a minute why, the market shrugged that off. And so that could have been a good excuse to sell off, but it didn't. And so with today's performance, that's pushed Fridays into positive annualized returns. Previously negative Mondays have been really bad this year, and hump day Wednesdays have been the best. So this is a good sign, especially going into the weekend when the market typically likes to take some risk off. And just to show you some interesting stats to put all this movement into context for you, we've gone over 15 sessions without consecutive up days. We haven't had 2 consecutive up days in almost a month. Previously, we only got this pattern once last year, once in 23, twice in 22, none in 21, and only once there in March 20. Like I said, that persistent slide kind of reminded me of that price action. So if we manage to buck the trend this year of weak Mondays and put in an up day on Monday, that'll bring an end about this stat. But it has been one of the weakest starts in the stock market for a new president. Looking at the S&P 500 indexed here to after inauguration day, currently down near one of the softest returns so far, currently about 40 days in to the new presidency. But again, something we notice with prior new presidents, we can see quite a bit of weakness there in the first couple of months. Maybe as the market recalibrates to a whole new admin and policies and outlooks. And here's another visual graphic, put this sharp pullback into context. S&P 500, 10% correction. The last one we got was in October 23. But you can see that actually took a couple of months to get there. This one, very sharp. Same graphic for the Mag 7 stocks. Actually did their biggest pullback this entire new bull market ever since we bottomed in late 2022. Mag 7's just come off 18%. Same deal for the Russell 2000, the most broad and diversified index out there. It too had its biggest and sharpest pullback of this entire new bull market. And so just looking at this chart here, indexing returns from months around the first Fed cut, which we got almost 6 months ago now. How we're currently tracking here in the orange, we had been quite visibly tracking the typical path of a soft landing, which we're still technically in, by the way. We've still got positive economic growth, corporate EPS growth, whilst inflation's coming down, allowing the Fed to cut rates because they can, not because they have to. However, we have had quite a bit of technical weakness this last month. And like I said yesterday, it's kind of getting down to crunch time. And typically, if the indices go down more than 15, 20%, makes it much harder for the market to bounce back and finish the year positive. But also with this data as well, if we were to go below the average here in the dark blue, technically at least that would be the market thinking we're on path for a recession, which of course is still possible. Anything's possible, but in my opinion, it's not probable. I'd put the odds of a recession this year probably somewhere between 20 to 30%, meaning I think there's about a 70 to 80% chance the market does find its feet soon. We defend this dark blue line and can maybe bounce back in Q2 because we are just coming off peak bearish sentiment. Looking at the AAPL Investor Sentiment Survey, bullish, less bearish readings. It's one of the lowest readings we've seen. In fact, the last time we were down here was in the market lows in 2022. The only other time we've been lower in the depths of the GFC back in early 09. But the market and many investors, big and small, are still extremely nervous. We can see that in the Fear and Greed Index. Even after today's big bullish bounce, it's still stuck in the extreme fear zone at 21. And we're still getting plenty of headlines and rhetoric alluding to the end of American exceptionalism and that this could be the start of a shift away from US stocks, which seems kind of strange to me because this is due to tariffs, which if they did escalate into a global trade war, it would actually be Europe and Asia that are most vulnerable. The US has the leverage. But like I said, I think a lot of people's politics and the headlines they're getting slammed with, and this goes for big institutional investors as well, are bailing on the US based on how they feel, not what's actually happening, nor how all this tariffs or even a full-blown global trade war is likely to play out. Plus, seasonally speaking, it's not all that unusual to see a bit of weakness in the first quarter of the first year of a presidential cycle. Like I said, the market can quite often recalibrate a new admin, and especially with this one, there is a lot to swallow. A record amount of executive orders, they hit the ground running, shaking up things all over the place. It's really no surprise to see a spike in volatility. However, if the fundamentals for America are improving and even accelerating, but we've also got a spike in volatility and fear, that could be fertile ground for a lot of opportunities. And this is something that's probably going to happen a few times over the next 4 years. And at the very least, really good for trading volatility. Or anyone into selling options, today was a great day. We got a huge volatility crush. With the VIX index coming off more than 11%, now down to a 21 handle. And I'll show you later what the VIX term structure is telling us, along with a few other things as well. And so looking back in history over the last 75 years, this was tied in 5th place for the fastest 10% decline we've ever had in the S&P 500. Funny enough, it was actually the Trade War 1.0 back in early 2018 that did even quicker, 13 days. So this move we've just had in the markets is really up there with terms of its velocity and fear spike. So the VIX has done pretty well not to go over 30, considering just back in August, we saw a bit of dislocation, spiked up to 65 there intraday, been relatively tame. And so like I said, whilst it's possible we can get a bear market, it's always possible. I don't think it's probable, especially looking at these stats here. Technically, we've had 2 bear markets already in the last 5 years. The quick one in 2020 and pretty much all of 2022. The indices, especially tech and growth shares, were down hard. If we were to get another one this year, that would truly be different this time. Looking back in history, it's almost 7 years between where bear markets start and closer to 14 for us to get 3 bear markets. So if we got one now, that would be 3 and 5, which again is possible. I just don't think it's probable. And here's another way to visualize drawdowns from 2-year highs in S&P 500. And this data is from last week. However, what it shows is just how rare big drawdowns are, like we saw in the GFC, the early 2000s, briefly there in the late 80s, then back in the inflation years in the 70s. However, looking at this stat up here, most of the time the market is in a 5% drawdown, over half the time, 57%. Over a third of the time, it's in a 10% drawdown. However, those worried about a big nasty bear market, down more than 40 or 50% of the time, they're really low odds. Market's only there less than 5% of the time. And when we do go there, it normally doesn't last long. Now, all us bulls need is just for this guy to shut his mouth and hopefully come out with some bearish headline next week why he doesn't believe in the bounce. And he has been talking a lot this week, doubting the new admin, also believing they could be destroying the market and economy, which I guess is a good contrarian signal. But like I said, I think the market breathed a sigh of relief. So it looks like we're averting a government shutdown, but that's more of a circus than any real threat to the market. It's always the same thing. We also heard the new Canadian Prime Minister, Mark Carney, say there's been progress in US trade talk. In his first news conference, he told reporters there's been progress in discussions with the US president after weeks of hostilities that have resulted in each country placing tariffs on each other. Carney actually came out and said, I respect what he is looking to accomplish. So like I said, don't be surprised if we do get a big blockbuster trade deal done with Canada and ultimately, and what I think the White House is trying to do, bring them all together, Mexico and China, get one big deal done, they're all on the same page. As these countries know, the new admin will push ahead with tariffs and they're likely to feel the pinch much more. With the new admin ignoring market volatility and happy to deal with it in the short term, staying firm on their long-term mandate. I think also helping things today as we're going into the NVIDIA AI conference next week, set to be held in San Jose, California. We're going to hear the latest about AI, robotics, automation with NVIDIA CEO Jensen Huang, set to deliver the keynote. And just looking at the price action in NVIDIA, it too certainly having a good day, slapping on over 5%. But stick with me because I'll show you the charts later on of other hot growth stocks and one sector really outperforming today. But just continuing with a few headlines, like the other one we got today, consumer sentiment actually coming in really soft, falling to a 29-month low. And this is a survey of how consumers are feeling, not what they're actually spending. And so just keep in mind the barrage of negative headlines being fed from the mainstream media to a lot of people. And so even though on the whole the consumer sentiment reading is soft, just looking underneath the surface, it really depends on who you ask. Because we can see here in the light blue, consumer expectations for Democrats not really surprisingly fallen off a cliff. Like I said, given the media absolutely smashing the new admin. On the other hand, Republicans still well above election levels, with independents just coming off a little bit as well. And let's not forget, most households do have stocks, do follow the stock market, and no doubt just based on price action. Plenty of people, red and blue, would have been feeling a little nervous over the last couple of weeks. Also saw a significant jump in inflation expectations. A lot of Americans think looking a year ahead that prices are going to go a lot higher. Now again, this stat, because it's based on expectations, like a lot of surveys have a big political element to them, because looking at actual prices in the economy, they're still disinflating, currently increasing at an annualized rate of 1.5%. And that's the lowest we've seen since inflation really kicked off back in early 21. And just looking at the market's expectations of inflation, still at a very similar level to that around the time of the election. Also looking at the spread of commodities to treasuries as well. Not really breaking out on the upside, but for sure, I still think inflation is more likely than a recession. But what happens if we don't get either? What happens if the market is wrong about the new admin? What happens if the result of all these tariffs ends up in US companies being able to sell more goods overseas? And all those investors, some really big institutions that rotated out of US stocks into European stocks so far this year, change course. We could get a big, swift repricing in the market, potentially in Q2. And something I like to see is the actions from someone who has their finger on the pulse of the consumer. And that's Best Buy CEO Corey Barry. She bought $1 million worth of stock after it's been smashed down. And this is her first on-market purchase since she was named CEO over 5 years ago, back in June 2019. And there's a look at the daily chart on Best Buy. This actually recently came in with the earnings beat, so it's good to see her buy a significant amount of shares after this earnings, and especially throughout this market rout with fears of a recession and inflation, consumer spending. We just had the CEOs of one of the most significant American retail stores completely leveraged to discretionary spending by the dip here. And so I'd trust her actions more than some whiny economists' political-driven predictions. But I guess it depends on who you listen to. But be sure to always question their motive. For example, Jeffrey Gundlach, billionaire bond fund manager, said gold's going to 4,000, but he also thinks we're more likely than not to get a recession shortly. But just keep in mind, he's probably talking up his own book, because it's in his interests for investors to be scared of investing in stocks. Stocks go down in a recession, bonds typically go up. He would love for you to invest in one of his mutual funds, being that he's the CEO and founder of DoubleLine. And looking at his floating rate fund here, got an average annualized return of 3.92%, which somehow people want to pay for that. I'm really not sure why. You can just get a CD, TD, or just a plain vanilla bond ETF. But he's definitely not worse than my favorite perma bear. And we just got a great contrarian signal from him right on time. Harry Dent, market crash coming this year. The hottest stocks could drop 99%. It's very nice to see this headline come out today. He said the fireworks have started and we have a bigger bubble and it's going to start bursting this year. Keep in mind, he said the same thing back in late 2023. There's an everything bubble that will burst in 2024. Didn't happen. He said the same thing back in 2022. Crash of a lifetime is here. Sell stocks now. Didn't happen. It was actually just a couple of months before the low. March 2021, biggest crash ever, likely by the end of June. Didn't happen. But like I said, this guy's a perma bear. His whole career is based on keeping you out of the market, selling fear. Hate to think how many billions of dollars he's collectively lost people by keeping them too scared to invest. But that's his job, to sell his books. March 2020, literally the low of the market. What to do when the bubble popped. September 2012, the great crash ahead. And literally right after we kind of had the last real crash in stocks, GFC. After the S&P 500 had fell 50%, he came out with a book, The Great Depression Ahead. So like I said, just because you see someone on TV in a nice suit, sounding real smart, got to question their motives because, like the old saying goes, bears sound smart, the bulls make money. And this goes double for the rhetoric currently being pushed by the mainstream media around Tesla. Once again, motivating lunatics to go and cause havoc around the country, also around the world, in Europe as well. We're seeing Teslas being torched, in addition to charging stations as well, set on fire. But like I said, the mainstream media, they'll respond to it and position it according to their elitist agenda, often driven by very ideological groups, many of whom have obtained their funding via US aid. But like I said, this is just a little bump in the road in the long-term story for Tesla. Seen it happen before, I'm sure it'll happen again. Plenty of people want to destroy this company, but it continues to live on. And what you're looking at here is a chart of Tesla in the blue line. It's data from yesterday actually, because we closed at 250 today. But here in the orange line is the average Wall Street analyst's price target, still sitting above 340. Looking back in history, whenever we get these large gaps, and this is one of the biggest we've ever seen in dollar and percentage term, it can quite often close with the price of Tesla always getting back above where the street's at. And so we did get a bit carried away at the end of 2024 there, almost $500 a share. My regular viewers will remember I actually said back then it was a good time to take a few chips off the table and trim. Given how technically stretched we were, I got some reversal signals and bullish sentiment was just so extreme. Just as my regular viewers know, I've been saying the exact opposite of late. We've flipped the other way, as Tesla can often do, and potentially showing signs of a technical bottom here. This pattern here is consistent with a technical bottom, but we very well may get a retest of that 220 level next week. And I very well may have just missed out on buying the dip on NVDA at 103. Got down to 104.7. I might have missed it by a point and a half. However, that's okay. That's investing. I only want to buy if I can get in at my price. Like I said, we've got the AI conference on Wednesday. Be interesting to see if NVIDIA can get above the 50-day VWAP and actually hold ground there. Similar with Apple as well. Quite oversold here. Bit of an inside day here. And Alphabet and Amazon still yet to prove that they've put in lows here. And while speaking about Wall Street analyst price target, one of the biggest divergences we've got going on out there is in trade desk. In fact, looking like the biggest divergence we've had between the stock price and where the street thinks it should be trading at, with the average price target at 111. And like I said, one of the most technically oversold stocks in the market. But if it were going to bounce, that could happen potentially next week. 5 reversal signals, that's the most we can get in a row, in addition to really good bullish seasonality over the next 1 and 2 weeks and 1 and 2 months as well. And just speaking of my seasonality forecast indicator, for anybody who doesn't already have it, today is your last chance to get it for free. Just click the link below this video or head on directly over to my website, clickcapital.io/free. All you got to do is enter your email and your TradingView username and just wait a few hours and you'll get this indicator added to your TradingView account as well. And like I said, I'm pulling down this page this weekend. So come Monday, this will be gone. And like I said, this is your last chance to get this indicator totally free in your account. And so this company's involved in digital advertising, 26 billion market cap, stable and growing quarterly and annual revenue. There's obviously been an outlook scare, even though earnings came in with expectations. But like I said, the street thinks it should be worth 111 all the way up here. And that gap could potentially close in Q2 as well. These really high growth stocks, some of them have just been whacked so hard, down 50, 70%. I mean, Tesla did over 50%, and it's one of the biggest stocks out there. And so if we don't go into a recession, some of these growth stocks are likely to have big bounces back in Q2, Q3, and there's plenty of them out there as well that are similar to trade desk and heavily oversold. But I guess the best thing for markets would be some official trade deals done, which is very possible in Q2, especially given America's largest trading partners not only rely on the American economy much more than vice versa, but they're in a much softer spot to start with. In fact, we just saw the United Kingdom, its economy actually contracted in January, flirting with recession. Not really a good time to dial up a trade war against the largest economy in the world. More better off trying to meet the states in the middle and get the best possible deal done for all involved. However, just keep in mind, a lot of European governments really don't like the new president of the states. They're not just going to say, okay, sir, where do I sign? They may actually have to feel a bit of a pinch first before they kind of get forced to come to the table. And we could also get deals done with Eastern Europe along with the Middle East as well. New admin very much wants low bond yields, a low dollar, and low oil to stimulate economic growth. But the lower we go, the more likely the US government can re-up their strategic petroleum reserve and buy the dip. And in fact, government traders may have just been doing that every time we hit $67 per barrel level, like we've seen for a little while now. And if things were really getting bad in the economy, I would expect interest rate traders to give more probability we're going to get a Fed rate cut in May. In fact, even though stocks finished lower this week and we got low CPI and PPI, lower than expected. Interest rate traders pushed out the odds that we're not going to get a cut until June. And like I said, in tandem with bond yields actually firming this week, the 2-year managing to reclaim 4% for the first time in a few weeks, along with just how firm global bond yields are as well. Looking at the Euro 10-year, even Japan and China moving up, along with how firm a lot of international stock indices are at the moment. Looking across the board here, like I said, bond yields and all these international stock indices holding up pretty good here. Doesn't suggest to me that markets are pricing in an imminent global trade war, global recession. Rather, like I said, there's just been a dramatic rotation out of USD assets. Looking at the S&P 500 versus the rest of the world. But like I said, what happens if they're wrong? We did get a few good technical signals here today. One of them being the difference between the volume of up stocks versus the volume and down stocks. It's a spread I like to keep on my watch list. UVol versus DVol came in 9.72 today. Almost 10 times as much volume going into up stocks than down stocks. And that's something we haven't seen since the 23rd of August, which was right after the market bottomed, after that big 5th of August scare. And just looking at the volatility market, whilst we still are technically in backwardation here, still got VIX front month a little bit higher than the second month, meaning there's still some chance things could get dicey next week. We maybe retest those lows, shake out any bulls from today. The odds are improving that we may have seen a bottom, especially when looking at the VVIX index. And that's volatility of volatility. Really came off hard today. And this can quite often lead the VIX, which is still a little elevated, but has come off sharply from that initial spike earlier in the week there. We almost got up to 30. Also got a nice bearish to bullish pattern here in high yield bonds. Higher highs, higher lows after a bit of a sharp sell-off there yesterday. And like I said, just looking at my themes watch list, did get some nice little bounces here across the board. Just looking at the nuclear trade, obviously many of them still well off their highs, but just looking at battery stocks, green across the board, space, Rocket Lab and others, getting some green across the screen there. AI, again, a lot of these stocks still down more than 50-60% from their highs, but we could be seeing some green shoots here today. Another one, Tempest AI. This could have a monster bounce over the coming weeks. There's Palantir trying to come back, but the real standout today was quantum computing. D-Wave Quantum up 46% on massive volume. Rigetti 28%, IonQ 16%, and quantum computing 29%. Again, kind of some more positive signs from high growth small caps potentially coming back. Okay, now on to what I alluded to earlier on in this video, a little known unique indicator. And so I recently just had somebody who's not active in the market ask me about the stock market, wondering what's going on. And nothing against that person, but I believe it's a bit of an indicator, representative, potentially peak bearish sentiment. And so that's what I mean by that little known indicator. We might not bottom until your relative, could be a parent, sibling, cousin, maybe even a neighbor, someone who's not normally active in the stock market. They might call you or text you knowing that you're active in the market and asking about your opinion on the market sell-off, maybe asking whether they should get out of the market. Those are usually some of the best signals, like I said, that we may have reached a peak in sentiment. So I'm interested to hear from you guys. Let me know in the comments below this video. Have any of you received a text or a call from a family member or relative asking about the stock market or what's going on or whether they should sell? Because like I said, that might be a signal that we've kind of reached a peak when most people are believing what the mainstream media headlines are forcing down their throats. So next week will be interesting. We've got the Fed meeting for their interest rate decision on Wednesday, the 19th. We'll get to hear the latest from Jay Powell. Market will be looking for his narrative towards the path of interest rates. And next Friday's OPEX, third Friday of the month. Along with heading in to the end of the quarter, we could see a lot of volume come in next week and the following week. Would be a good time for the market to stage a V-shaped recovery. But like I said, the next question will be, when we inevitably come back up and touch the moving averages, will the market roll back over or will it find its feet, find some support and push back up? Like I said, we got official trade deals done in Q2. I'd be surprised if the market doesn't rip higher. But of course, at the moment, it's really back and forth day to day on tariff headlines. And of course, fears over Q1 GDP growth, consumer spending. And for sure, a lot of consumers aren't feeling that great at the moment. But technically speaking, pretty positive sign here. Bearish to bullish flip. My risk on indicator's gone back green. Oscillator's almost out of the oversold territory. And of course, nobody knows for sure if we've definitely made the bottom. I would just say the odds got a lot better today. And how we trade on Monday could be telling as well. If we don't take out Friday lows on Monday and we can actually string together 2 consecutive up days, that'll once again increase the chances that Thursday was a low. And we do have a little bit of buzz going into the NVDA AI conference on Wednesday as well. That could help things move along with a pretty sizable crush in volatility in the second half of this week, but still not quite out of backwardation just yet. So I'd say we're getting there. but can't say for 100% sure right now. But I would say the odds are better than 50% that we're in the process of making a low as it stands right now. That's all I got for you this week. Thanks very much for sticking with Click Capital. I'm always interested to hear your comments. And like I said, if you're interested in getting my seasonality indicator 100% free, now is your last chance. Click the link below this video or just head on over to my website, clickcapital.io/free, and follow the instructions today. Otherwise, have a great weekend, and I'll be back again as usual come Monday night. Cheers.